What's the investment outlook for the next 12 months? How is the outlook translated into an actionable strategy? What's the best way to embed that strategy into real portfolios? At Quintet, our approach is one of global diversification. I think the outlook for the dollar, US treasuries, is going to be key for global markets. I'm Daniele Antonucci, Chief Investment Officer at Quintet Private Bank, and this is Spot and Forward.
Hello everyone, welcome to the second episode of Spot and Forward series on debunking investment. Geopolitics, AI and market shifts, how do these themes actually influence portfolio construction? To unpack this, I'm joined by Daniele Antonucci, CIO at Quintet Private Bank. Daniele, welcome back and thank you for being with us.
Thank you, Vincenzo. Thanks for having me again on Spot and Forward on behalf of Quintet.
Before we dive into portfolio strategy, could you walk us through the major macro and market views currently emerging as key for investor and guiding your thinking? What are the top 3 ideas on your radar right now?
Yeah, sure. To recap, I think we can say, number 1, we want to diversify in equities away from the US into other markets. I mentioned Europe, the UK in sterling portfolios, Japan. Strategically, we want to look at emerging markets as well, and also diversify away somewhat from technology into other sectors. That's the idea number 1. Secondly, in fixed income, we think we want to be underweight US treasuries. We believe the US dollar is like to depreciate. Here, the key risk is government debt, and so we want to have a lesser exposure to the dollar. And finally, diversification across other assets. Alternatives is an example. We like gold strategically in portfolios. These are the 3 key ideas that come from our outlook.
You mentioned trade tariffs and geopolitical fragmentation, but also AI. Once you have identified those big picture trends, how do you actually translate them into investment calls, into decisions that impact real portfolios?
Very important. Let's talk about investment decision making. So at Quintet, we have an investment committee. I have the honor and pleasure to chair that committee. This is the final decision-making body. Research is represented there at the committee, portfolio management, our investment specialists across investment and client solutions of the different regions and locations where we have operations. So the investment committee gets advised by the research team, spanning the different asset classes, macro, fixed income, equities, the different solutions, fund manager research, alternatives research across liquid and illiquid assets, structured products and derivatives, and we have portfolio management as well. Once a call is made, through a constant loop of feedback, iteration coming back to the committee, eventually that gets to portfolio implementation to get applied to real portfolios.
Can you break down the key stages of your investment process? How do those stages help you to make sense of today's complex and fast-changing world?
So the investment process, in a very stylized way, has several stages. And by the way, it all comes together to the investment committee. But you could think about the first step is what we call strategic asset allocation. This is the whole portfolio. It's designed to match the long-term return objectives of our clients. It's designed to make clients comfortable with their risk tolerance. And our strategic asset allocation is dynamic. It's not fixed. It's not just a simple benchmark to beat, but it has active decisions. Which asset classes you want to include, what sort of turnover you want to achieve. There's many examples that we could give, but the key point is that it is dynamic. Our strategic asset allocation might account for maybe north of 3/4, 80% of the expected return. Then the second step is shorter term, is our tactical asset allocation. It is tilting portfolios one way or another over the next 6 months or 12 months in a way they reflect our outlook. Obviously, we want to make sure that we leave a margin of safety in case our base case doesn't materialize. In a quintet, we think a lot about scenario analysis. That's the second step, the tactical process. You would say that the first step, the strategic one, is at a lower frequency, quarterly with an annual, more comprehensive refresh, or ad hoc, if conditions were to warrant that. The tactical process is monthly or higher frequency, maybe ad hoc again, because it aims to capture discrepancies in different market perspectives and prospects. The final step is instrument selection. We need to populate the model portfolio with actual financial instruments, and then it goes all together in a portfolio construction setup to get embedded into real client portfolios.
Let's talk philosophy. What's the core belief system that underpins your approach to investing, especially in a world that is moving away from old certainties?
Very important, and just to be clear, there is much more to an investment philosophy than broad principles. But when we think about these broad principles, I could highlight 5. So the pillar number 1 is what we call wealth protection and growth. We want to strike a balance between capital appreciation, that tends to be objective, the longer-term objectives of many investment strategies, but at the same time, we aim to mitigate downside risks. That's the pillar number 1. The second pillar is active portfolio management, and the third is investing with conviction. So we are active investors, global investors, we invest with convictions. These convictions come from our outlook. And then number 4, we can talk about open architecture. That's very important. We try to access capabilities, best-in-class, cost-effective capabilities wherever we can find them. We combine these capabilities into a coherent strategy, but the main point is that we want to make sure that we access these capabilities as an extension of our own. We work with active fund managers, we work with independent research providers, we have deep relationships with a lot of asset management companies. The open architecture, therefore, is the 4th pillar. And finally, client preferences and sustainability. At Quintet, working with BlackRock, we developed a differentiated suite of mandates that can deliver on specific investment objectives. Income could be an objective, extreme of cash flows. Another objective could be sustainability, a higher degree of sustainability compared to our typical strategy. Or another objective, another mandate is about gaining broad market exposure in a cost-effective way by changing the mix of active and passive instruments that we use in portfolios.
You work with wealth clients who care about growth, but also about preserving capital. How do you strike that balance between pursuing returns and managing downside risk?
You said it very well, it is a balance. And there's many ways to think about wealth preservation, to think about having a wealth preservation mindset. So the first way to think about it is this idea of global diversification. And again, it's not just a static long-term concept. We think about it strategically, at longer horizons, by trying to seize opportunity wherever we can find it and mitigate risk wherever they come from. We think about it tactically, trying not to do the same thing everywhere in the portfolio. Each and every position has a role. Could be offense, could be defense. And we think about with specific strategies depending on the portfolio. For example, we recently invested in derivatives instruments that appreciate when US equities fall. You need to think about it like an insurance. There is a price for that insurance that you pay, but under certain conditions can help mitigate the downside. The final point I want to make about wealth preservation and growth is that it is a dynamic process. We want to make sure that we capture opportunity that we stay invested, compound returns and longer horizons, but at the same time there are periods of enhanced volatility where we tilt portfolios in a way that they strike more a balance between wealth preservations and capital appreciations at longer horizons.
And last, how does all your macro work, strategy research, and the market insights get expressed in the portfolios you manage? Can you give us a concrete example or two?
Well, yes, I can give you a couple of examples. The first one is our recent call on Japan. So Japan is a market on the equity side that we think attractively valued. And so we got the work and the collaboration between our equity team with our macro strategies. They look at the corporate governance reforms. They look at the yen and whether the Bank of Japan could trigger a significant currency appreciation that would be negative. A moderate currency appreciation is positive because we gain when we translate any yen gain into euros. So there was a lot of collaboration between our asset class teams from equities to fixed income and macro. Then we work with portfolio managers, the portfolio construction team, and the fund manager research team to find the right instrument, the right size of any overweight call on Japan equities and embed that in portfolios. So that's example number one. The example number two is more strategic, if you like. It's about our global diversification approach. When you look at this, given the high degree of concentration in the market, the US, the technology sector, just a few companies, the Magnificent Seven, that account for such a big share of US equities, we have decided structurally to look at other markets as well. We have a slight home tilt in our portfolios when it comes to European equities because of the structural changes that we are seeing, the extra integration, infrastructure, defense spending. So with our asset allocation team, our macro research team, our equity strategists, once again, they all collaborate together, take that view, come up with a proposal to the investment committee, access the work of third-party content providers, asset managers, like I mentioned before, research specialists, to make sure that the view is translated into an actionable position that then we insert into client portfolios.
This has been an outstanding look at the real mechanics behind the investment strategy. Thank you, Daniele, for giving us a glimpse into how you navigate the macro landscape and make it count in the portfolio. It has been a real pleasure, and we look forward to continuing this important dialogue in our next episode.
The pleasure was mine, Vincenzo, and I look forward to the next and final episode of The Banking Investment.